Everyone thinks markets move when the news breaks. When a headline flashes across your screen, a big announcement hits the wires, and suddenly, the world reacts. But if you spend enough time in front of these charts, especially in those quiet hours when the rest of the world is waiting, you know the truth. The real move almost never starts with the news. It starts long before it. It starts quietly, without any fanfare, in the tiny spaces between orders where the market breathes. Most people never notice it, but if you learn how to watch, if you zoom in on that narrow window, maybe an hour before a major economic release, or in that heavy silence just before liquidity dries up for the day, you'll see something strange. Prices begin to drift. They start to tilt, to shift, as if they're responding to a whisper that no one was supposed to hear. You might see a single candle start to lean in one direction, or the spread between the bid and the ask tightens in a way that feels unnatural. Maybe you'll notice the order queue subtly rearranging itself without any obvious reason. It's never dramatic. It's not a big, loud signal that screams, buy here, or sell now. It's just a soft imbalance, building quietly beneath the surface. It's completely invisible to anyone who isn't paying close attention, but it is absolutely unmistakable to those who have learned to listen to the rhythm of a market preparing for impact. Most traders just write this off. They'll say it's anticipation or smart money positioning. They'll use vague phrases like, the market knows, but the real explanation is much colder, more mechanical. Markets don't anticipate things like we do. They don't have emotions or gut feelings. They react. They react to tiny micro-frictions that accumulate inside the order book long before the public has any clue what is about to happen. What does that look like? It could be a subtle shift in the balance between aggressive buyers hitting the ask versus passive sellers just waiting with their orders. It might be a quiet withdrawal of liquidity, where large resting orders are suddenly pulled from the book. Or maybe one side of the order book tightens up, while the other side swells with hidden intent. It doesn't look like a clear signal. It certainly doesn't feel like a warning. It just appears. It's soft. It's persistent. It's almost shy in how it presents itself. Until, suddenly, it isn't shy at all. All at once, the price jolts in a direction that seems to come from nowhere, leaving most people scratching their heads. And by the time that big, flashy headline finally appears on your newsfeed, the market is already somewhere else entirely. It's already moved on. It's already digesting a reality the rest of the world hasn't even seen yet. If you're there, standing in front of a screen as this imbalance builds, you can sense it even before you can fully understand it. You feel this tension building in the way the tape prints its orders, in the way liquidity seems to hide and reappear, in the way the spread behaves like a nervous animal getting ready to run. You don't know what the news is going to say. You have no idea when it's going to hit, but you feel something tightening in the market structure, a pressure that the market tries to disguise, but ultimately cannot contain. This is the closest thing that finance has to a heartbeat. It's a faint, rhythmic distortion that tells you someone somewhere is leaning into the book. Someone is absorbing more supply or demand than they are revealing. Someone is positioning themselves not with words or rumors, but with pure, raw weight. This video is all about that weight. It is about the unseen pressure inside the order flow that moves prices before the world even sees the headline. We're not talking about rumors. We're not talking about intuition or some magical sixth sense. And we are definitely not talking about narratives. We are talking about a mechanical truth that is buried deep beneath the surface of the charts you look at every day. And that truth is this: imbalance always comes first. The news always comes later, and the traders who truly understand this simple fact never have to wait for the announcement to know which way the world is about to tilt. So, how do we see this? How do we quantify this invisible pressure? It starts with understanding the order book, not just looking at the levels, but understanding the dynamics. The order book is a ledger of intent. On one side, you have buyers, on the other, you have sellers. But it's not just about who wants to buy and who wants to sell. It's about how they want to do it. Are they passive, placing limit orders and waiting for the price to come to them? Or are they aggressive, hitting the market with orders that execute immediately at the current best price? The imbalance we're looking for lies in the relationship between these two forces. For example, let's say a big news event is coming up. The conventional wisdom is to wait for the number, see if it's good or bad, and then trade the reaction. But the professional approach is to watch the order flow in the minutes leading up to the release. You might see a huge wall of passive sell orders sitting just above the current price. At the same time, you see a steady stream of small, aggressive buy orders getting absorbed into that wall without the price moving up. What does this tell you? It tells you that there is a large, patient seller who is willing to absorb all the incoming buying pressure. They are holding the price down. This is absorption. It's a classic sign of a hidden imbalance. The aggressive buyers are trying to push the price up, but a larger, unseen force is holding it in place. The market looks calm, but beneath the surface, a battle is being fought, and the side with more weight is winning. Then, when the buying pressure finally exhausts itself, the price has nowhere to go but down. And when it starts to fall, it falls hard, because all the buyers are already in, and now they are trapped. The news might come out and be neutral or even slightly positive, but the market tanks anyway. Why? Because the real move wasn't about the news. It was about the exhaustion of buyers that happened minutes before the release. The imbalance told the story before the headline was even written. This happens in reverse too. You might see a large number of aggressive sell orders hitting the market, but the price refuses to go down. It's being held up by a large, unseen buyer who is quietly absorbing all the selling pressure. This is another form of imbalance. The sellers are throwing everything they have at the market, but the price isn't budging. Once the sellers run out of steam, the path of least resistance is up. These are not just theories. These are observable, repeatable patterns in market data. They are footprints left by large institutions, by algorithms, by the so-called smart money. They can't just jump into the market with a single massive order. That would move the price against them and give them a terrible entry. So instead, they have to be clever. They break their large orders into smaller pieces. They use sophisticated algorithms to work their orders into the market over time, trying to be as invisible as possible. But they can't be completely invisible. Their activity always leaves a trace. It creates friction. It creates these subtle imbalances in the order flow. And if you have the right tools and know what to look for, you can see these traces. You can see the weight they are putting on the market. Think of it like trying to spot a submarine. You can't see the submarine itself, but you can see its wake on the surface of the water. In the markets, the order flow is the water, and the imbalances are the wake. Now, this isn't about predicting the future with 100% certainty. Trading will never be about that. It's about stacking probabilities in your favor. It's about moving from a 50-50 guess to a much higher probability setup. When you see a significant order flow imbalance forming, combined with the key technical level on your chart, and happening just before a catalyst event, you are no longer just guessing. You are making an informed decision based on the real-time flow of money in the market. This is a fundamental shift in perspective. Most retail traders are focused entirely on price. They draw lines on a price chart. They use indicators based on past price. They are, in effect, driving by looking in the rearview mirror. But price is just the effect. The cause is the flow of orders. By learning to read the order flow, you stop reacting to old information and start anticipating what is likely to happen next based on the actions of the biggest players. You start seeing the market not as a random series of candlesticks, but as a living, breathing auction process, driven by supply and demand. Let's be clear, this isn't easy. It takes screen time, it takes practice, and it requires you to unlearn a lot of the conventional wisdom you've been taught. It means looking beyond the simple patterns and digging deeper into the market's underlying mechanics. But the payoff is immense. It's the difference between being the last to know and being one of the first. It is the difference between being run over by the market and riding the wave that others are creating. The imbalance comes first. The news comes later. That's the secret. It's not about having inside information. It's about understanding the information that's already there, hidden in plain sight for anyone willing to look. The next time you're watching the markets ahead of a big announcement, don't just stare at the price. Watch the flow, watch the tape. Look for the subtle shifts, the absorption, the hidden weight. Because the market is telling you a story. You just have to learn how to read it. Stay with us. Because what you are learning here doesn't just change how the markets look, it fundamentally changes how they move. Long before our modern markets were defined by complex algorithms, lightning-fast data feeds, and order books filled with hidden intentions, traders understood a very uncomfortable truth. Prices rarely moved when the world expected them to. They moved before. In the early trading pits of Chicago and New York, the frantic shouts and wild hand signals of floor traders masked something much deeper than just noise. There were patterns of pressure, imbalance, and invisible accumulation that subtly pushed prices hours, or even days, before the newspapers ever printed their stories. A veteran floor trader once famously said, "By the time news hits the street, the move is old." He wasn't speaking in metaphors. He was describing the primitive form of a mechanism that would later become one of the most guarded secrets of modern finance, the order-flow imbalance that builds just beneath the surface, quietly shaping the future long before the public hears a single word. But back then, this imbalance didn't have a name. It lived inside the instincts of people who could literally feel the shift in the crowd, the tightening of volatility, the strange, brief silence just before the floor erupted into chaos. Markets had memory, but they also had a kind of intuition, the kind that emerged from thousands of micro-decisions happening faster than any single person could possibly interpret. When electronic trading came along and replaced all that human noise with cold, hard precision, many believed the market would finally become clean, rational, and completely transparent. They imagined that by removing human emotion, they would strip away the mystery that had haunted markets for decades. But what they didn't realize was that in removing the surface noise, they actually revealed a deeper architecture. This new structure was no longer disguised by human behavior, but was instead defined by the mathematical skeleton of liquidity itself. And within that skeleton, the old imbalance resurfaced in a brand new form. A persistent misalignment between the pressure of incoming orders and the market's capacity to absorb them. Electronic markets didn't eliminate anticipation. They made it measurable. They exposed how liquidity would silently peel away right before major events, how one side of the order book would lean much harder than the other without any obvious explanation, and how spreads behaved like a staging ground just before a battle had even begun. The mystery wasn't gone. It had simply moved underground. By the early 2000s, exchanges all around the world had adopted fully electronic limit order books. Every single bid and offer became a digital artifact, time-stamped and sequenced with terrifying accuracy. This is when researchers started to uncover the very patterns that floor traders had known for generations, but could never prove. They found that prices consistently moved ahead of major news events, not because someone was leaking information, and not because insiders were whispering secrets. It was because the mechanical structure of the order book itself responded to pressure long before the narrative ever caught up. Think about it. When traders expected uncertainty, they pulled their liquidity. When algorithms detected an imbalance, they automatically adjusted their inventories. When passive orders sensed aggression building up on the other side of the market, they retreated. Every single one of these reactions happened in microseconds that no human could ever perceive in real time. And when millions of these tiny reactions all aligned in the same direction, the price shifted not after the news, but before it. This was the moment markets crossed a critical threshold. News no longer caused the move. It simply came along to explain the one that was already in motion. Some of the earliest documented examples of this phenomenon emerged around high-impact economic releases. Before major announcements like payroll numbers, central bank decisions, or inflation prints, researchers found consistent, repeating patterns in the market's microstructure. They saw a thinning of liquidity at key price levels, a noticeable skew in the depth between the bid and the ask, and an uptick in aggressive orders clustering in one direction. To the untrained eye, these shifts would have looked completely random, like meaningless noise. But to those who studied order flow data, they were footprints in the sand. They were clear evidence that markets behave less like simple reaction machines and more like incredibly sophisticated pressure valves. They prepare for impact. They adjust before the shock arrives. And in doing so, they reveal their intention long before the rest of the world catches on. This isn't just a theory, it's a pattern that has repeated itself with shocking consistency during almost every major financial crisis of the last 20 years. Let's travel back to 2007. The global economy seemed fine on the surface, but cracks were starting to form in the mortgage credit market. Most people were completely unaware. Yet, in the equity markets, something strange was happening weeks before the first major headlines warned of a crisis. Liquidity, the lifeblood of the market, began to dry up. Think of liquidity as the amount of buying and selling interest at any given price. When it's high, trading is smooth. When it's low, things get volatile. And back in 2007, the depth of the market, the layers of buy and sell orders started to evaporate around key price levels that had been stable for months. Sell orders began to pile up, creating a massive imbalance. Passive liquidity providers, the big players who keep the market stable, quietly started reducing their exposure. They sensed the risk. So when the news about the mortgage crisis finally hit the mainstream, the market wasn't just starting to fall, it was already halfway down the cliff. The same thing happened again during the infamous 2010 flash crash. In a matter of minutes, the Dow Jones plunged nearly 1,000 points, only to recover just as quickly. The official narrative blamed a single large sell order, but the real story was hidden in the market's microstructure. In the moments leading up to the crash, there was a complete vacuum in liquidity. Prices collapsed faster than any human could process or any narrative could form. Later analysis revealed the seeds of the crash were visible long before it happened. A persistent imbalance between buyers and sellers, thinning layers of resting orders, and a silent retreat by market makers who sensed the structure was about to break. They didn't need a headline. The order flow told them everything. By the time the Swiss franc shock hit in 2015, this pattern was no longer a surprise to professional traders. For years, the Swiss National Bank had pegged the franc to the euro, promising to keep its value stable. Then, one day, they abruptly abandoned that promise. The franc skyrocketed in value, wiping out traders and even entire brokerages. But again, it didn't happen in a vacuum. Hours before the official announcement, liquidity providers had already started to pull out. The gap between buy and sell prices, known as the spread, became wider. The market's depth became dangerously thin. The order book was practically screaming that something was wrong. When the peg finally snapped, the market didn't react with surprise. It reacted to a structure that was already primed for collapse. The imbalance had already decided the outcome. The news was just the final confirmation. This brings us to the pandemic-driven panic of 2020. The pattern repeated itself with ruthless clarity. Before the Federal Reserve announced its emergency measures, before governments formalized lockdowns, before the world truly understood the scale of the impending crisis, the markets were already signaling their fear. Bid depth, the support from buyers vanished. Sellers completely dominated the market, creating relentless imbalances on the sell side. Prices began to slide in a way that felt like they were anticipating the bad news, not just reacting to it. While retail traders and news anchors blamed fear and speculation, the professionals knew the truth. The market was writing its own future in the language of its microstructure, long before any headline even existed. So, what exactly is this order flow imbalance? It's simply the dynamic struggle between buying pressure and selling pressure at a microscopic level. Imagine a tug of war. For a price to stay stable, the force from buyers and sellers needs to be roughly equal. But when one side starts to pull harder when large, aggressive orders come in, or when passive liquidity on the other side disappears, the rope starts to move. This movement, this imbalance, is the very engine of price change. This phenomenon has always existed. In the old days of open outcry trading pits, floor traders had an intuition for it. They could feel the mood of the pit change. They could see the hesitation in other traders' eyes. And they knew when a big move was coming. Today, we don't need intuition. We have data. Electronic trading leaves time-stamped footprints of every single action. Modern machine learning models can analyze billions of these micro-interactions every second, detecting shifts in the order flow that are imperceptible to the human eye. But whether it's a trader's gut feeling or a sophisticated algorithm, the pattern remains the same. Prices move first, and the explanations come later. The most unsettling discovery isn't just that imbalance precedes news, but that it does so with such incredible consistency. Across decades, across different assets like stocks, currencies, and commodities, and through all kinds of geopolitical cycles and technological shifts, markets have always prepared themselves before the rest of the world understood why. This isn't a psychological phenomenon driven by fear or greed. It's structural. It's built into the mechanics of how liquidity behaves when it's faced with uncertainty. The primary job of market makers and liquidity providers is to manage risk. When they sense increased risk, even if they don't know the exact reason, their first instinct is to pull back, to reduce their exposure. This act of self-preservation is what creates the imbalance and starts the chain reaction. In our modern era, where algorithms dominate trading and every millisecond matters, this predictive power of imbalance has grown even stronger. High-frequency trading firms have built entire strategies around detecting and responding to these subtle shifts in microstructure before any human possibly could. The moment pressure starts to tilt, market makers adjust their inventory. The moment uncertainty rises, liquidity disappears from key price levels. These automated, mechanical interactions create a silent prelude to the story that will eventually be told in headlines. It's crucial to understand this is not manipulation or some grand conspiracy. It's not about a few powerful people knowing the future. It is the natural, mechanical behavior of a complex system designed to anticipate pressure because its very survival depends on it. The market is a risk pricing machine. It doesn't wait for a formal announcement to start pricing in risk. It senses it in the flow of orders. Think of it this way: the world reads the news after the fact. Markets read the imbalance before the fact. And once you truly grasp that one simple idea, your entire perspective on markets will shift. There's a moment in every market cycle when the narrative breaks. It doesn't happen because of a shocking headline or because analysts suddenly change their minds. It's something deeper, a quiet shift within the very structure of the market, a change that can't be undone. At first, it's so subtle that even experienced traders dismiss it as just random noise. But once it starts, the system enters a new phase. Imbalance no longer waits for a news catalyst. It begins to create its own momentum. This is the twist that almost nobody sees coming. The market doesn't move because a few insiders got the news early. It moves because the underlying architecture has already reached a critical tipping point. In that moment, price stops being a follower and becomes the messenger. The whole idea of the market simply reacting to events completely falls apart. You first notice it when you see a market leaning in a direction that makes absolutely no sense. There's no data release, no official announcement, not even a whisper of a rumor. Yet, the price action prints with a strange, undeniable insistence, as if someone, somewhere, is quietly putting weight on one side of the scale. The imbalance that was just a faint whisper before is now starting to speak clearly. And you see other signs. Liquidity starts to thin out, but not randomly. It disappears precisely where the next wave of pressure is expected to hit. Resting orders vanish from the book, almost as if they're anticipating a storm. You see a rise in aggressive trading, not because traders are suddenly feeling bold, but because the system's own gravitational pull is shifting. Price starts moving in small, persistent steps, like a tide slowly rising before the moon is even visible in the sky. And then, in that slowly rising tide, something becomes uncomfortably clear. The market is no longer waiting. It has already made its decision. The real twist is that this behavior doesn't need any advance information. It doesn't require someone leaking a central bank's next move or having insider knowledge of an economic report. This behavior emerges naturally from the structure of liquidity when it's under stress. Here's how it works. As uncertainty grows, even without any concrete news, market participants start protecting themselves. It's a natural instinct. Market makers reduce their inventory. Traders pull their passive orders off the books. Sophisticated algorithms detect this thinning depth and adjust their strategies instantly. This kicks off a self-reinforcing cycle. Less liquidity leads to a greater price impact for each trade, which makes the imbalance seem larger, which in turn causes even more participants to pull their liquidity. What looks like informed anticipation from the outside is actually a structural chain reaction. There's no grand conspiracy, no secret group chat. It's just a mechanical truth, hidden so deep within the market's plumbing that most people mistake it for intuition or luck. This is where the market reveals its most profound secret. Imbalance is predictive, not because traders can see the future, but because liquidity itself behaves according to incentives that come before the future happens. When the risk of volatility rises, even subtly, every single player, acting to protect themselves collectively, creates a pressure that pushes the price toward the very outcome they are afraid of. The structure amplifies its own weakness. By the time the actual news arrives, the market has already repriced the world. Think about the tense hours leading up to a major central bank meeting. The popular belief is that insiders are busy positioning themselves ahead of the announcement. But if you look closely at the market's microstructure, you see something entirely different playing out. Liquidity doesn't wait for the official minutes or the chairman's speech. It reacts to the silence. It reacts to the hesitation. It reacts to the collective retreat of participants who would rather pull their quotes than stand exposed in a moment of high uncertainty. That very retreat becomes a powerful signal in itself. Algorithms, trained on millions of historical data patterns, interpret that signal as a growing imbalance. So, they act. Their action then amplifies the signal for others. And so, price begins to drift. Not because anyone knows what the announcement will be, but because the market structure is reacting to its own reflection in the mirror. The twist becomes undeniable when the news finally drops. To the untrained eye, it looks like the market explodes in a sudden, violent reaction. But for anyone who is watching the microstructure, that explosion feels late. The real move, the decisive one, already happened quietly in the shadows. What the headline triggers is merely the second act, the loud and visible part of the play. The invisible first act, the one that truly mattered, played out in the thin, quiet hours before the rest of the world was even paying attention. Most people see the dramatic price swing and assume that's the cause. They're wrong. The cause was already written in the language of imbalance long before the headline came out to confirm it. And once you understand this, a deeper truth emerges. The market is not a thermometer passively reacting to the temperature of the global economy. It is a complex pressure system that adjusts itself internally long before the outside world even acknowledges the heat is rising. Imbalance is not a byproduct of news. It is the precondition. It's a structural warning shot. It's a quiet reconfiguration of liquidity that speaks a language only a few know how to hear. This brings us to a crucial realization. If imbalance can reshape price before the news, then the story that headlines tell us is always, by definition, incomplete. What truly moves markets isn't what is said aloud. It's what is sensed deep inside the architecture. What the world calls a reaction is often just a delayed recognition of a reality that has already formed. And what most people mistake for chaos is often the exact opposite. It is the system following its own hidden rules with perfect, mechanical precision, just as it has for decades, in silence. To understand this, we need to forget everything we think we know about fair value and dive into the architecture of the modern market. At its core, the market is an order-driven structure. Prices aren't set by analysts or committees. They're the direct result of millions of micro-decisions competing for priority inside a constantly shifting limit order book. It's a world where the only thing that truly matters is how liquidity behaves. Think of liquidity not as a static pool of money, but as a living organism. It shifts, it hides, it withdraws, and it reappears, all driven by incentives, not by news stories. When those incentives tilt, even slightly, an imbalance begins to build silently, mechanically, and unconsciously. The market starts drifting in a direction it hasn't yet explained to the world. Let's visualize the order book as a ladder of intentions. On the lower rungs, you have bids people willing to buy, but only if the price comes down to them. On the upper rungs, you have asks people willing to sell, but only if the price rises to meet their level. These are the passive orders. Then you have the aggressive orders the market buys and sells. These are the players who don't want to wait. They consume, the intention sitting on that ladder. If more aggressive buys hit the book than aggressive sells, the price climbs the ladder. If the reverse happens, it falls. But here's the crucial part most people miss. It's not just about the aggression. It's about the capacity of the order book to absorb that aggression. 100 aggressive buy orders might do absolutely nothing if the ask side of the ladder is thick with sellers who are confident and comfortable. On the other hand, just 10 aggressive buys could send the price soaring if the ask side is thin, hesitant, or retreating. This dynamic is the very foundation of order flow imbalance. It's not just about how much pressure enters the market, but how much pressure the market can withstand at that exact moment. And that capacity to withstand pressure is constantly changing, reflecting fear, uncertainty, and opportunity long before those emotions ever make their way into a news headline. Now, let's look at the real-world evidence of this, because it's not just a theory. There are structural changes in our markets that make this phenomenon more powerful than ever. The first is the thinning of market depth. Depth refers to the total amount of resting liquidity at the best bid, and ask prices the very top rungs of our ladder. And this depth has been steadily declining for over a decade. According to Nasdaq market data, the average top of book depth in major U.S. stocks has plummeted by more than 70% since 2010. Let that sink in. 70%. It's not just in stocks. In the massive U.S. Treasury market, the Securities Industry and Financial Markets Association, or SIFMA, reported that the average on-screen depth dropped from over $400 million in 2012 to under $100 million by 2020. This is a structural collapse in available liquidity. These statistics reveal a simple but profound truth. The modern market is thin. And in a thin market, even a whisper of imbalance can be amplified into a significant price movement. The market has become incredibly sensitive. This brings us to the second part of the mechanism: price impact sensitivity. This is a measure of how much the price moves for every unit of net order flow. It's not just that the markets are thinner, it's that every trade now has a bigger punch. Studies from the Bank for International Settlements showed that in foreign exchange markets, price impact has been rising steadily. A net buy flow today moves currency prices nearly twice as much as it did in the early 2000s. We see the same thing in equities. Research on the S&P 500 shows that the same amount of trading volume that would have moved the index by 1 basis point back in 2005 can now move it by almost 3 basis points. This exponential sensitivity is the environment where imbalance thrives. When small shifts have such amplified consequences, it means the market can drift a considerable distance on very little actual information, long before the news provides a convenient reason for the move. The car is already rolling down the hill before anyone shouts that the brakes have failed. So we have thinner markets and higher sensitivity. The third and final piece of the puzzle clicks into place when uncertainty rises. Think about the hours leading up to a major economic announcement, like the Consumer Price Index, a Federal Reserve meeting, or a big jobs report. What do traders and market makers do? They reduce their exposure. They tighten their inventory. They pull their orders. Passive orders retreat deeper into the book, moving further away from the current price. It's a collective, instinctual act of self-preservation. This isn't just a hunch. It's been documented repeatedly in market microstructure studies. For instance, an analysis by the derivatives exchange Eurex showed that in the 2 hours before major macro announcements, top-of-book liquidity falls by an average of 30 to 50%. At the same time, the imbalance between the bid and ask depth, the asymmetry on our ladder, grows by more than 25%. Similarly, research from the University of Chicago observed that just before a company releases its earnings report, the asymmetry in the order book increases significantly as market makers reduce their one-sided exposure, not wanting to get caught on the wrong side of a surprise. These findings confirm what experienced traders have felt in their gut for decades. Liquidity can sense uncertainty before the narrative does. Before a single word of the news report is public, the market's internal structure is already changing. The bids and asks are reconfiguring themselves. One side of the book becomes heavier, the other becomes lighter. This isn't because anyone has a crystal ball. It's a mechanical reaction to perceived risk. And this mechanical shift creates a path of least resistance. If the ask side thins out dramatically before a CPI report, it takes far fewer aggressive buy orders to push the price up. The market is preloaded, primed to move in a certain direction. When the news finally hits, the subsequent price move often looks like a sudden, shocking reaction. But in reality, the groundwork was laid hours before. The imbalance had been quietly accumulating. The path had been cleared. The news simply acts as the catalyst that ignites the pre-existing fuel. The world scrambles for a reason, pointing to a specific data point in the report. But the real story was written earlier in the silent language of the order book. So, the next time you see a market moving without a clear reason, don't just look at the headlines. Look deeper. Understand that you are witnessing the consequence of a silent battle between aggressive and passive flow, playing out on a landscape of thinning liquidity and heightened sensitivity. This means there are fewer orders resting on the books, ready to absorb buys and sells. Because of this, the price impact of every single trade is higher than ever. And when a big economic announcement is on the horizon, the largest players pull their liquidity out of the market to avoid risk. This creates a fragile environment where even a small, persistent push in one direction can trigger a major price move. Think about it. We're not talking about a huge, dramatic signal. A tiny, 5% skew in aggressive buy or sell orders is enough to start tilting the entire market when the order book is sparse. Even a single algorithm changing its quoting strategy can shift the balance. Imbalance isn't a rare event anymore. It's a structural inevitability of how markets operate. But the most fascinating part isn't the imbalance itself. It's how the market responds to it. This response happens in 4 distinct phases, and understanding them is the key to seeing what really drives price. Let's dive into phase 1. Liquidity pre-selection. This is what happens in the hours or even days leading up to a major news event, like an inflation report or a central bank decision. Market makers, the big players who provide liquidity, aren't just sitting around waiting. They are actively recalibrating their risk. They look at metrics like implied volatility, basically the market's fear gauge. As uncertainty about the news event grows, this gauge goes up. We often see implied volatility climb 10 to 20% in the days before a big announcement. When this happens, what do the market makers do? They protect themselves. They reduce the size of their orders. They widen the spreads between their buy and sell prices, and they move their quotes deeper into the order book, further away from the current price. This creates a liquidity vacuum. It's like they're pulling the safety net away, which means even a small, random imbalance can now push the price much more easily. The market becomes incredibly sensitive. This brings us to phase asymmetry amplification. As the shape of the order book changes, sophisticated algorithms are watching one key metric: the ratio of aggressive buy volume to aggressive sell volume. You can think of this as the heartbeat of the market's microstructure. When this ratio tilts just slightly, say above 1.1 for buys or below 0.9 for sells, studies show a significant increase in short-term price drift. This isn't just theory. Research from major banks has confirmed this. A JP Morgan study in 2020 found that in the stock market, a sustained imbalance ratio of just 1.15 over a 5-minute period predicted an upward move with nearly 70% accuracy. In the foreign exchange market, a similar tilt predicted the direction with about 60 to 65% accuracy. Now, this isn't a crystal ball. It's a structural signal. It's telling us that when one side of the market starts leaning, the whole system begins to tilt with it. Now for phase 3. Where things get really interesting. The feedback loop formation. Once the market starts drifting in one direction because of that initial imbalance, a powerful chain reaction begins. Other algorithms detect this drift. How do they respond? Not by fighting it, but by joining it. This isn't manipulation. It's just smart risk management. Liquidity providers are terrified of what's called adverse selection. That means they don't want to be the ones selling to a market that is about to rocket higher, or buying from a market that's about to collapse. So, to protect their inventory, they pull their orders from the opposing side, widen their spreads even more, or skew their own positions in the direction of the drift. And what does this do? The retreat makes the market even thinner, which increases the price impact of every subsequent order. This increased impact magnifies the original drift, and that magnified drift reinforces the algorithm's decision to retreat in the first place. You see the loop? Imbalance causes drift. Drift causes liquidity to retreat. The retreat causes higher price impact, and higher impact creates even more imbalance. This self-reinforcing cycle can last for minutes or even hours, producing a clear, visible price move long before any news headline validates it. This all culminates in Phase 4, the pre-news break. At a certain point, the price has moved so much that traders watching the chart start to think, wow, someone must know something. But here's the secret, usually, no one does. The movement isn't based on secret information. It's the natural, logical consequence of the market's internal structure being put under tension. By the time the actual news is released, the groundwork has already been laid. The order flow imbalance has carved a clear path. The market's liquidity has already reshaped itself around the expected shock. So when the news hits, the market reacts instantly, not because the information is so surprising, but because the entire structure was already aligned and leaning in one direction. The news just becomes the match thrown onto dry grass that was already waiting to ignite. And the data backing this up is overwhelming. Research published by the Federal Reserve in 2017 found that in the Treasury markets, over 40% of significant price adjustments happened before the scheduled information releases. A Bank for International Settlements survey in 2022 showed that a third of all intraday volatility spikes in currency markets happened in the pre-news window, driven almost entirely by this process of liquidity withdrawal and order flow imbalance. In equities, a Goldman Sachs analysis from 2020 revealed that nearly half of the S&P 500's drift on major event days happened before the event. But the most striking evidence comes from the behavior of high-frequency trading algorithms. These HUFs control a massive chunk of the market, upwards of 50 to 70% of equity order flow. They operate on microsecond-level signals. When they detect an imbalance accumulating, they respond almost instantly, amplifying the drift even further. A fascinating study from MIT in 2019 confirmed that HUF quoting behavior changes as much as 800 milliseconds before major news is released. That's far too fast for any human to read, interpret, and react to the news. But it's perfectly consistent with the structural incentives that are hardwired into the market's microstructure. Then you have the phenomenon of dry liquidity zones. These are price levels where the order book is deceptively empty. They act like cracks in the pavement. When an imbalance pushes the price into one of these zones, the move can accelerate violently, creating those price gaps you sometimes see on a chart just minutes before a news release. People scream front-running or cheating, but it's not. It's just the market's structural fragility revealing itself under pressure. So by now, you should understand the real mechanism. News doesn't move markets, order flow does. News simply acts as a catalyst, accelerating a direction the market was already structurally predisposed to take. That pre-news drift you see on the chart isn't a prediction, it's preparation. When a market is facing uncertainty, it instinctively lowers its guard. It widens its spreads, reduces its depth, and shifts its inventory to protect itself. In that weakened state, even gentle, persistent pressure from one side of the order flow is enough to create movement. And once that movement begins, the feedback loops we discussed kick in and amplify it. The result is a price change that seems almost psychic to those who only watch the headlines. But it's entirely logical to those who watch the order book. This is the unseen engine of the market, the silent architecture that operates beneath every chart, every candle, and every surprise move that most traders attribute to luck, manipulation, or some unsolvable mystery. Once you understand this engine, you finally see the truth that he's been hiding in plain sight all along. The market doesn't wait for the story. If there is one lesson you should carry with you long after this video ends, it is this: the market is never blind. It is never surprised. It is never waiting for the moment the world thinks matters most. Long before headlines declare a shift, long before analysts rewrite their forecasts, Long before anyone claims to understand what happened, the market has already begun to move. It's not because it sees the future, but because it feels the pressure building underneath it, silently, invisibly. This pressure is called order flow imbalance. It's not some trick or a loophole. It is the structural pulse of a system that reacts to uncertainty the way living organisms react to danger, quietly at first, subtly withdrawing, tightening, leaning, preparing. And in that preparation, everything that will eventually become visible already exists in its embryonic form. The public sees the event. The market sees the tension. This is the part most people never grasp. They assume news drives price because news is the only thing they see. They forget that price does not wait for clarity. It moves the moment liquidity changes shape. It responds to imbalance, even when the cause of that imbalance is nothing more than collective hesitation. Think about that for a second. The market doesn't need a reason to move. It just needs a shift in pressure. And because modern markets are built on thin depth, fragile liquidity, and microsecond reactions, that hesitation translates into movement faster than any narrative can form. The story you read in the financial media is always the shadow of an event that has already played out inside the order book. By the time you read about it, it's old news to the market itself. But the warning buried in this truth is deeper than just mechanics. It is not simply that markets move early, it is that markets move in ways that reveal what participants fear most. Before crises, imbalance tilts heavily as liquidity providers retreat, pulling their bids and offers off the table. Before euphoria, imbalance builds as a flood of buyers overwhelms the passive sellers. Before structural breaks, both sides of the book fracture, unable to absorb even small waves of aggression. In these moments, price is not drifting. It is confessing. It is showing you the fault lines people pretend aren't there. If you learn to listen to this confession not through indicators, not through predictions, but through the silent reconfiguration of liquidity, you will understand markets in a way most never do. You'll stop believing that headlines explain anything. You'll stop assuming that price is chaotic. You will begin to see the architecture beneath the noise, the pressure beneath the narrative, the imbalance beneath the move. And once you see that, you cannot unsee it. The illusion of randomness dissolves. What remains is a system that whispers before it speaks. Let me give you a more concrete example. Imagine a large, quiet lake. On the surface, it's perfectly calm, but deep below, a geological fault is shifting. The water pressure begins to change, creating subtle currents that are invisible from the shore. Then, suddenly, a huge wave erupts from the center of the lake, shocking everyone who thought it was stable. The wave wasn't random. The pressure had been building all along. The order book is that deep, hidden part of the lake. The news headline is the giant wave that everyone sees, but it's the last thing to happen, not the first. This is why chasing news is a losing game. You're reacting to the wave, not the pressure that created it. The real skill is learning to detect those subtle shifts in pressure before they erupt. So, the final warning is this: do not mistake surface calm for stability. The most violent market moves rarely begin with drama. They begin with silence, with spreads that widen by just a fraction, with market depth that thins out at unexpected levels, with aggressive flow that tilts just enough to shift the balance of pressure. These are not accidents, they are the system readjusting itself ahead of impact. If you wait for the news, you are already late. The headline is not the start of the story. It is the confirmation of what the structure decided hours, days, or even weeks earlier. And yet, this is not a message of fear. It is a message of clarity. The market is not unknowable. It is not mystical. It is not controlled by invisible hands or hidden conspiracies. It is governed by incentives, by liquidity seeking safety, by market makers protecting their inventory, by algorithms responding to imbalance, by participants acting not on secret knowledge, but on structural necessity. When you observe price through this lens, you stop asking, what news caused this? And you start asking, what pressure shaped this before anyone noticed? That shift in perspective is the difference between watching the market and understanding it. It's the difference between being a passenger, tossed around by the waves, and learning to read the currents underneath. It's about recognizing that every candle, every jump, Every drift is part of a deeper conversation happening beneath your screen. A conversation between liquidity and fear, between imbalance and opportunity, between structure and uncertainty. You were never meant to hear it. Most people never will. But now that you have, the question becomes, what will you do with that knowledge? It's a powerful concept, and it changes everything about how you look at a chart. It transforms noise into information. It reveals a hidden logic where others only see chaos. If you found this perspective valuable and want to explore more of these hidden mechanisms, stay with this channel. There are far more systems like this beneath the surface of global market systems that shape our world long before the world even realizes it. We'll be diving deeper into these ideas, peeling back the layers one by one. And in the shadows of those systems, the truth speaks quietly. Just before the lights fade,